Dr. Mariot, please.
Good morning, everyone, and welcome to the first session of this year's BOJ-IMES conference. After the inspiring opening words by Governor Ueda and the Mayakawa lecture by Austin Carstens, it's a pleasure for me to open discussion today with a topic that lies at the very heart of contemporary central banking: the interplay between reserve demand, interest rate control, and the challenges we face with quantitative tightening. Over the past decades, central banks all around the world have expanded their balance sheets in an unprecedented way. As we now have moved into a period of monetary normalization, understanding how far and how fast balance sheets can be reduced without hampering the control over policy rates has become one of the key questions for us. This is especially relevant for those of us implementing monetary policy with a floor system, where interest rates on reserves plays a central role. This also raises deeper questions. How strong is the structural demand for reserves? How should the interest rates on reserves be set to maintain control? What are the limits and risks of shrinking or normalizing the central bank's balance sheet? We are extremely fortunate to have with us today the leading expert to guide us through these complex issues. It's my honor to introduce Dr. Annette Vissing-Jorgensen, a senior advisor in the Division of Monetary Affairs at the Federal Reserve Board and a former professor of finance and economics at the University of California, Berkeley. Annette's research has significantly shaped our understanding of monetary policy transmission, the demand for safe assets, and the role of central bank balance sheets. Her work is characterized by rigorous empirical analysis and a strong focus on policy relevance. Today, she will present a joint paper with David Lopez-Salido titled Reserve Demand, Interest Rate Control, and Quantitative Tightening. This paper offers both a theoretical foundation and empirical estimates of reserve demand with direct implications for how central banks can navigate balance sheet reduction while maintaining effective interest rate control. It's a timely and important contribution, not only for the Fed, but also for all of us. At the Eurosystem, we will soon face these questions as the next review of our operational framework will take place next year. I very much look forward to the insights and discussions Annette's presentation will spark. After the presentation, we have Professor Hibiki Ichiue from Keio University discussing Annette's findings. So please join me welcoming Dr. Vissing-Jorgensen. Please, Annette, the floor is yours.
And thank you, Thomas, for the very kind introduction. Good morning, everyone. So I should give the usual disclaimer, and remember, I'm just a staffer, not a policymaker, so don't take what I'm saying too seriously. All right, so let's think back to before the financial crisis. Central banks were doing conventional monetary policy, and in terms of reserves, well, at the Fed, they didn't earn interest, and therefore reserve demand was modest. Nonetheless, reserve supply was scarce as the Fed kept reserve supply low enough that it operated on the very steep part of reserve demand, which allowed the Fed to control short-term interest rates by relatively modestly sized open market operations. Then came the financial crisis and the effective lower bound. Central banks around the world started doing unconventional policy, including QE and forward guidance. Reserve supply expanded massively, and the Fed started paying interest on reserves. So just to familiarize those of you who are not used to thinking about the Fed's balance sheet specifically, I thought it might be helpful to just position where are reserves on the Fed's balance sheet and how they evolved over time. So the Fed's assets consist basically of securities and lending, where at the Fed we mostly have securities and more treasuries than mortgage-backed securities. On the liability side, the way that the Fed funds its balance sheet is through reserves, is the largest item, you can think of the Fed as a bank that takes deposits from commercial banks, and so reserves are commercial banks' liquid deposits with the Fed. The Fed also funds itself partly with repo financing from non-banks, predominantly money market funds. That's the overnight reverse repo, the ONRP balances. And then, of course, there's currency, which is large, and then there's government deposits, which at the Fed are called the Treasury General Account, and some smaller other categories, including, for example, the foreign repo pool. All right, so in terms of central bank balance sheet, keep in mind the expression at the bottom. We're going to use it along the way. Thinking about this over time, you can see how the Fed's assets and liabilities, the black line is the same in either, indicates the size of the Fed's balance sheet. You can see the dramatic rounds of quantitative easing and tightening. And if you look at the liabilities, you can see how the black and red line co-move substantially. That says that when the Fed wanted to fund QE, it predominantly used reserves to do so, and conversely during the periods of QT. But keep in mind also that the Treasury General Account in green has fluctuated a lot, reaching almost 2 trillion at one point, and these ONRP repo borrowings by the Fed for money market funds have also fluctuated substantially. All right, so what we specifically would like to know about reserve demand in this post-GFC period is 3 things. What is the role of reserve demand for ensuring that the Fed hits its target, that the effective Fed funds rate clears where we want it to clear, so in other words, for interest rate control? What are possible operating frameworks to limit the impacts of shocks coming either from reserve demand or from the autonomous factors, by which I mean currency and government deposits? And third, how can we use reserve demand to guide quantitative tightening? So I'm going to do this basically in 2 steps. I'm going to lay out a simple graphical framework, and then I'm going to estimate reserve demand guided by that framework and speak to the questions that I laid out. So let's start with reserve demand. Let's switch gears to a different balance sheet. Now it's the balance sheet of a commercial bank. Therefore, the reserves are now an asset, and the other assets and liabilities are what you would expect. There's 3 features of reserves that are relevant for thinking about reserve demand. One is that, as discussed, reserves now earn interest. At the Fed, we call it the IOR. At other central banks, this would often be called the deposit facility rate. We don't have tiering, so I'm just going to have one interest rate in reserve for all reserve amounts. That makes reserves a useful investment from the bank's perspective, simply from a store value perspective. But reserves are also useful because they have additional benefits. We're going to call those convenience benefits, and they come from liquidity and regulation. Specifically, if you're a bank managing deposit in and outflows or lending flows, you can do so without transaction cost and without delay if you manage them with reserves. And from a regulatory and supervision perspective, reserves are useful to satisfy, in the old days, reserve requirements, which we no longer have, but in the newer days, things like the liquidity coverage ratio. I'm going to capture the convenience benefits with a convenience value function, V. And a key object in the analysis will be how that convenience value changes with more reserves. So V prime R is just the value of $1 extra reserves. It's the first derivative of the convenience value function with respect to reserves. So that V prime R, the convenience, which we'll call the convenience yield, is going to be declining in reserves as an additional dollar reserve is increasingly less useful for managing deposit flows. But importantly, the convenience yield is going to be increasing in the bank's need for liquidity, which we're going to capture by deposits, specifically liquid deposits. Finally, banks face a balance sheet cost, which for simplicity I'm going to assume is constant. You can think of this as stemming from capital requirements. Okay, so given this, reserve demand is straightforward. It's what is the price, in this case, what is the interest rate that the bank is willing to pay to borrow to get reserves and benefit from these benefits and costs. So the one equation in the talk will be the one at the top that says that the bank's reserve demand function is given by the highest interest rate that the bank is willing to pay to borrow to get more reserves. And that's going to be a function of the 3 inputs, the interest rate and reserves, the convenience yield, net of the balance sheet cost. So I graphed out reserve demand in the chart here, and the downward slope simply comes from the declining convenience yield. The level shifts up with interest rate and reserves and down with the balance sheet cost. And when in central banking we talk about scarce, ample, or abundant reserves, that's a statement of how far to the left or right we are on the demand curve. So if you look at the equation at the top, then you could think of reserve scarcity as a measure of whether the banks find reserves useful above and beyond the fact that they pay interest. So reserve scarcity in our framework is captured by V prime R minus phi, which I'll call the net convenience yield and reserves. When that's positive, you are above the IOR, the top dashed line. We say that reserves are scarce. To the far right, by contrast, the convenience yield has gone to 0. So we are down at IOR minus phi. There we say reserves are abundant, and then ample reserves are in between. All right, now, conceptually, I could have written down this first order condition based on any source of funding for the bank. I had stated it using an uncollateralized rate, which I'm later going to map to the effective Fed funds rate, but I could have done this same first order condition in terms of repo rates, and then I would have to account for the fact that in repo you have to post collateral. We're going to capture that by that little A in the top left, and the main lesson here is that while we're going to estimate equations of the first form that I laid out, the Fed's facilities are nonetheless going to be relevant because the Fed's facilities for controlling interest rates, although they're collateralized, are going to indirectly also control the uncollateralized rate, and we're going to estimate that spread A along the way. All right, let's move to reserve supply. A simplified version of the same Fed balance sheet you saw before tells us that if you isolate reserves, there's going to be 3 parts. The first is securities minus the autonomous factors. We're going to call it net securities. And this is just the part of securities that the Fed didn't fund with the autonomous factors, and thus they needed some funding from reserves. And then we have the lending, so this is the central bank lending to banks. And then we have the reverse repo for central banks that have a reverse repo facility. And so that's the expression for reserves. Now from that, you immediately get the reserve supply function. Net securities is going to be the vertical part. And then the top flat part, you probably all were aware of already because you know that central banks act as a lender of last resort. We stand ready to provide more reserves when needed by the banking sector. The bottom flat part is a little bit more subtle. We actually also at the Fed stand ready to lower reserve supply if interest rates would have otherwise cleared too low. And that's going to be happening through this ONRP facility. All right, so if we put these together, we have the equilibrium. That's going to be 3 types depending on where reserve demand hits reserve supply. The first type here is where reserve demand hits on the vertical part. In this example, or in this type of equilibrium, there's no use of the facilities, the floor or the ceiling facilities. But notice that the Fed actually has a lot of impact on the equilibrium here, because not only does it choose the size of net securities, it also chooses the interest rate and reserve. So effectively, the supplier can control the demand curve by making the product better or worse, in this case by changing the IOR. So accordingly, a first lesson from this framework is that we as central banks have many choices. And I have illustrated 2, focus first on the chart to the left. These are points 1 and 2 are 2 ways in which the Fed can reach the same target for the short market clearing rate, the effective Fed funds rate. At point 1, the Fed has chosen a low interest rate in reserve, so the reserve demand curve is quite low, but has chosen a small reserve supply, whereas at point 2, the Fed has chosen a high IOR, but also a higher supply. You can see in the equation in yellow that those 2 combinations could conceptually get you to the same interest rate. And one way to summarize that is with the chart to the right, which we call the ISO Fed funds rate curve. The y-axis is different. It's now the IOR. So the chart summarizes combinations of the IOR and reserve supply that leads to the same market clearing rate. So you can think of this ISO Fed funds rate curve as simply how to set the interest rate in reserves given the reserve supply in order to hit the target. All right, the second type of equilibrium happens if the reserve demand hits supply on the bottom flat part. And that happens essentially if the market rate would have otherwise cleared too low. So absent the ONRP facility in this chart here, the market would have cleared at 0.1. But with the ONRP facility, lenders will not be willing to lend at the low interest rate at 0.1. Instead, they lend at the ONRP facility and the net securities will be funded by a mix of reserves and ONRP, as indicated in the chart. This equilibrium happens if the Fed has a big balance sheet, or if reserve demand is low, or if the ONRP rate is high. All right, the final type of equilibrium happens if reserve demand hits the reserve supply on the top flat part. In this case, the banks will borrow, since they wouldn't want to borrow at an interest rate as indicated by 0.1 in the private market if they can borrow from the Fed at an interest rate as indicated by 0.2. So a key lesson from this framework is how the central bank controls the market interest rate through several choices that it makes. One, the amount of securities holdings, but also these administrated rates, both the IOR that sets reserve demand, as well as the floor and the ceiling facility rates. And one insight that comes out of this is that the private sector's actions are what really keeps the interest rate clearing between the floor and the ceiling. We saw the comparisons of the points 1 and 2 that I just went through. All right, so now we have a good sense of how does the Fed, how do central banks more generally set the interest rate on reserve to hit the target given its choice of securities holdings. But now what about shocks? So there's actually quite a few approaches for dealing with shocks. So what shocks do I have in mind? So at the Fed, one large shock is fluctuations in the government deposits in the Treasury General Account. Those are under those autonomous factors and will thus affect the vertical part of my reserve supply curve, which remember is net securities minus the autonomous factors. And then, of course, there's the potential for reserve demand shocks. So the way that the Fed approaches shocks is to keep the reserve supply large and rely on backstop facilities. Let me start with the Fed's approach here. So to the left, I'm illustrating the effect of supply shocks from the autonomous factors, and to the right, the role of demand shocks. The point of the chart here is to say that if you are down on the pretty flat part of reserve demand, then neither supply shocks nor demand shocks, if they're horizontal at least, will have much impact on the equilibrium interest rate. We could have redone the pictures where we were working way up to the left, and there you would have gotten quite a lot of interest rate volatility out of those same shocks. So this is a useful approach. It does require a good understanding of the reserve demand function and as well as the potential shocks. One concern that one could have is that since the facilities are backstop facilities, one could worry that perhaps banks are not ready to use them. Could be a lack of operational readiness, for the banks to use them when they're really needed. One can also worry about stigma because their facilities are not used in normal times. All right, so what are some alternative approaches to dealing with shocks? One is what I would call active securities. So this is simply to try to keep the vertical part of the supply curve unchanged in the face of shocks to the autonomous factors. So specifically, suppose the government deposits go up, then normally net securities would go down, but you can prevent that by increasing the Fed's holdings of securities, or conversely, when the government deposits go down. Now, one way you could do this, if you did this, then you would ensure that the short market rate would be unaffected by shocks to the autonomous factors. Now, of course, if you're changing securities, you may worry that that could have an effect on the term premium. So one practical way of implementing this active securities approach would be to change the Fed's holding of Treasury bills. Then you would also have no impact on the term premium, so the short rate would be unaffected by the supply shocks, and the longer rates would also be unaffected by the supply shocks. So your policy stance would basically be entirely unaffected by fluctuations in the government securities. In the government deposits. A third approach is what I call active borrowing. The Fed has used that when the ONRP facility had a lot of take-up, and that provided a lot of stability actually to interest rates, in the sense that when you're operating on the bottom flat part of reserve demand, well then, if there's a fluctuation in supply, you can see that's not going to change the equilibrium. And if the reserve demand function shifts, well, that's going to automatically be accommodated by a shrinkage or increase in the ONRP facility, thus leaving the market interest rate at the same level. That does require large net securities holdings, and so that's a potential drawback. The final approach is what you call the Bank of England approach, which is sort of active lending, which is to operate on the top flat part of supply. The idea, again, is that you can see if the vertical part of supply changes in response to autonomous factor shocks, it's not going to change the equilibrium. It's only going to change the mix of non-borrowed and borrowed reserves. And similarly, if the demand curve shifts, well, that's going to be accommodated. So the general idea, as you look through all these approaches, is that the ones other than the Feds try to accommodate reserve demand shocks and insulate reserves from supply shocks. So just to wrap up this part, let me compare the Fed and the Bank of England approaches. You can see the Fed approach here in green with the green supply and the Bank of England approach in red. The difference is that the Bank of England has chosen a lower ceiling facility rate and a lower net securities supply, thus inducing banks to borrow some reserves on the margin. So there's some possible advantages to this. For one thing, there's probably going to be less interest rate volatility because the Bank of England is literally at the top part of the supply. Also, you could say if the Bank of England's repo facility is used in normal times, you can be a bit more sure that there's not going to be stigma. So the ceiling may actually hold better. There's an issue also, or an advantage in terms of a lower profit risk at the Bank of England, in the sense that if you think about the contrast between securities and lending as a central bank asset, the securities have duration risk, but the lending is generally floating rate and so doesn't have duration risk. A third advantage of the Bank of England approach is that it frees up assets for the private sector to hold. Notice how the vertical part of the red line is lower than on the green line. And finally, an advantage of the Bank of England approach is that you don't really need to understand reserve demand, the shape as well. You don't need to understand the impact of the shocks because you're just going to be fluctuating on that top red line. All right, so let's estimate reserve demand and get some implications for the setting of the IOR as well as QT. So at first, when I got to the Fed, I thought, look, this is going to be really difficult because it's well known that reserve demand is pretty unstable. So to illustrate that, here I'm plotting the Fed funds IOR spread against reserve supply. Within our little model from before, that's going to be V prime R minus V. And you can see how it's pretty unstable. That's the case even if you scale reserves by GDP. But if you pay close attention to that one first order condition in yellow, you already know that you need to account for the size of the banking sector because we had deposits in there as a shift of the convenience yield on reserves. And so in the paper, we assume that the net convenience yield on reserves is log linear in reserves and then in liquid deposits. Plug that into that same first order condition, and we have the estimating equation in yellow, which we estimate in monthly average data going back to the beginning of 2009. In practice, remember that when the ONRP facility is binding, essentially there's censoring of the effective Fed funds rate. So I'm going to have a little max operator in here to account for that. But let me just show you that it does matter whether you control for deposits or not because they have been going up a lot over time. The left focus on the liquid deposits in red. In the left chart, you can see in billions of dollars, liquid deposits have gone up substantially. And in the right chart, even relative to GDP, they have gone up, although they have subsequently returned part of the way post-COVID. Okay, so there's not a whole lot going on in this estimation, but nonetheless, it works out really well in the sense that the R squared is as high as 97%. You can see the fit in a chart to the right where the blue dot is data, the red is the fitted. The green is how low the Fed funds IOR spread would have gone without the ONRP facility, so that shows you the effectiveness and the importance of the ONRP facility in times of a big Fed balance sheet. Reserve demand is very elastic, so the numbers imply that if the spread goes down by 10 basis points, reserve demand goes up by as much as 50%. So it's very elastic, but not flat. All right, so to summarize the reserve demand estimation, you can contrast the picture that I showed you with an unstable reserve demand to the left with a summary of estimation to the right where I have changed the x-axis. So I literally just reorganized the estimating equation and put on the x-axis what we call deposit-adjusted reserve supply. And you notice the nice fit. And keep in mind that September 2019 is the month with the highest predicted spread. That's going to be important in a second. All right, so then we can get to using this estimate reserve demand for policy. Let's start with the setting of the interest rate and reserves. Okay, so this is going to be actually relatively straightforward in that we have a way to calculate the predicted Fed funds IOR spread for any possible reserve supply given liquid deposits and given the Fed's setting of the ONRP rate relative to the IOR. So then to hit a given target, what you need to do is you need to set the IOR such that the IOR plus the predicted spread is equal to the target, which means you need to set the IOR equal to the target minus the predicted spread. Okay, so the way that that looks in practice is like this. The left chart gives you the predicted spread as a function of reserve plus ONRP, where that's just equal to reserves when you're to the left of the kink, and then on the bottom flat part, that's when there's ONRP take up. So that's the predicted spread, and then we can calculate the IOR needed to hit a given target. Let's just pick a number, 5%, and you can see that when the Fed has a smaller balance sheet, then it needs to set then reserves are scarcer, so it needs to set a lower interest rate on reserve to hit a given Fed funds target, and conversely when the balance sheet is larger. So we think, well, the idea of an ISO Fed funds curve it goes back to a theory paper by Bianchi and Biggio. We think this is sort of the first empirically estimated version of this. Is that what the Fed does? Yeah, actually pretty close. So the thick red line in the chart to the left illustrates which value of the interest rate and reserve would, over our sample, have allowed, do we think, let me say that again. Which value of the IOR do we estimate it would have taken for the Fed to always hit the middle of the target range, given the evolving deposits and so forth? So that's the thick red line. The thin red line is the Fed's actual choice of the IOR, and both are relative to the bottom of the target range. And you can see that the contours of these are roughly similar. Notably, during the period of QT in 2018, 2019, reserve scarcity went up, and the Fed accordingly lowered the IOR in order to ensure that the Fed funds rate cleared within the target range. Nonetheless, the thin red line is a bit less volatile. What happened in practice is that the Fed has not been quite as proactive about changing the IOR that it would have needed to in order for the Fed funds rate to clear exactly at the target rate midpoint. I'm illustrating that in the right, where the blue line is in daily data. It's the Fed funds IOR spread in the daily data. And you can see that the Fed has allowed some volatility within the range. But if you look really carefully, you can see whenever the blue line gets within 5 basis points of the top or the bottom, the Fed has adjusted the IOR. Okay, so the message here is that the Fed knows the basic principles here and has followed these general ideas pretty well over our sample. Finally, some thoughts about quantitative tightening. So how does reserve demand affect quantitative tightening? We can't really have an opinion about this without discussing what are we trying to do with the balance sheet above the effective lower bound when we don't need a particular balance sheet for stimulus. So if you think about our mandate as central banks, generally it's monetary policy, financial stability, and, as Augustine laid out, money supply. Okay, so monetary policy doesn't tell you much about your balance sheet size above the ELB because you can hit the target for any balance sheet size. So let's move on to financial stability and money supply. So what we're trying to avoid from a financial stability perspective is another yield spike like the one we saw both in the effective Fed funds rate and in the repo rate in these two charts back on September 17, 2019. Now, remember before I said, notice how the highest predicted Fed funds IOR spread was precisely in September 19? So that suggests that the predicted reserve scarcity from the estimation can be used to assess when we might have contracted the balance sheet too much in the sense that interest rate volatility picks up. So the predicted value in September 19, the predicted reserve scarcity was 4 basis points. What reserve supply today would generate a predicted spread of 4 basis points, given today's banking size as measured by liquid deposits? So we estimate that that would happen for a reserve plus ONRP supply equal to 2.3 trillion, and that by the time you got to that value, the ONRP take-up would be 0, and there would be all reserves. We also include a prediction interval, which is pretty wide, but that's probably too much reserve scarcity if you're worried about financial stability. So for reference, we also estimated when do we think that the scarcity would hit 0, and that happens for a supply of about 2.8 trillion, which is, both of those numbers are substantially below the latest actual value, so there's quite a bit of ways to go. Another, and this is the final point I want to make, another approach to thinking about QT is the third mandate, money supply. And so you might think, oh, wait, wouldn't that also suggest that we should have a pretty big balance sheet? You know, we've already seen that financial stability suggests you should keep a pretty big balance sheet, you know, reserve supply over 2 trillion. Wouldn't that also be good from a money supply? You know, reserves are money for banks. Shouldn't we just supply a lot of them? You could say, why don't we just follow the Friedman rule and keep supplying reserves until we hit 0 scarcity? So that, it turns out, is actually not the right way of thinking about it, given the fact that the Fed has announced that it plans to predominantly hold treasuries in the longer run. And that means that we basically need an updated version of the Friedman rule, accounting for the fact that when the Fed supplies money in the form of reserves, it basically takes away a money-like asset from the private sector to hold, namely treasuries. Okay, so suppose we as a central bank wanted to maximize the private sector's convenience benefit from both reserves and treasuries. Then we can contrast two cases. In case A would be if the Fed didn't hold treasuries, then it could just forget about the blue part at the top and maximize the net convenience benefits that the banks got from reserves. It would then choose 0 net reserve scarcity, that's the Friedman rule. But given that the Fed has decided to hold mostly treasuries, then basically the blue and red components at the top become linked, because when the Fed supplies more reserves, it does so by buying treasuries. And then the prescription is, and this is sort of Annette's version, updated version of the Friedman rule, is to equalize the convenience yield on reserves and treasuries. That would imply a substantially smaller balance sheet. I calculate this out. This is a slide based on my Sinter paper from a couple of years ago. That would require quite a lot lower reserve supply. There's, of course, huge confidence bounds, but let's say a number less than 1 trillion, in contrast to more than 2 trillion from financial stability. And I estimate in that paper that the reserve and treasury convenience yield would equalize around 30 basis points. Okay, that's a lot higher than those 4 basis points we had before. And you might say, wow, that's a lot of scarcity. Let me remind you that, you know, we used to operate with 500 basis point reserve scarcity at the Fed back when the IOR was 0, in a case where the nominal interest rate was 5%. The ECB operated with around 100 basis point scarcity, and, you know, the world didn't fall apart. So this is not as radical as it sounds. So to conclude, I've laid out a framework for how to think about reserve supply and demand. I hope you found it helpful and relatively straightforward. The specifics, of course, need to be adapted to each central bank, but you can see that this is relatively straightforward in terms of just drawing the supply curve correctly, given the facilities that you have chosen. Some key lessons are, for interest rate control, that the interest rate and reserve need to change with balance sheet size, that you have a choice of operating framework in terms of how to deal with shocks. I contrasted the Fed and the Bank of England approach, and highlighted the potential benefits of this active securities approach as well, related to the government deposits at the Fed. And then I estimated the reserve demand, emphasizing the stable reserve demand you can get if you control for liquid deposits, and we talked through the practical implications for setting the IOR, as well as for quantitative tightening. Thank you.
Thank you, Annette, for the insightful presentation. To offer a discussion on your paper, I now have the pleasure of inviting Dr. Hibiki Ichiue, Professor of Economics at Keio University here in Tokyo. Professor Ichiue is a well-respected scholar in monetary economics and has deep understanding of central bank operations, shaped by both his academic work and his earlier experience at the Bank of Japan. Please join me welcoming Professor Ichiue to deliver his comments.
Good morning. I'm Hibiki of Keio University. Thank you very much for this great opportunity to discuss this very interesting paper. Let me start my discussion by summarizing this paper. Okay. So federal operations are very complicated. It uses IOR as well as floor and ceiling facilities. In addition, its security holdings affect the short-term money market. So to understand this complicated situation, this paper provides a novel framework of reserve and supply, reserve, demand, and supply. In this framework, demand curve is not affected by floor and ceiling rates. On the other hand, supply curve reflects those facilities. This paper estimates the demand curve using data from 2009, and this is the baseline results. And according to this, to stabilize the EFFR IOR spread, reserve supply should increase more than 1-to-1 in response to liquid deposit in an equilibrium. So this is an important finding in this paper. This paper also discusses possible approaches to limit interest rate volatility and also considers the implication for the 2019 rate spike and QT. This paper has been already presented in many places, including a lot of central banks. So I'm not sure if I can give a good comments to this revised paper, but let me try. From now on, I will give 2 comments, and then finally, I will discuss Bank Japan's operations from the perspective of this paper's framework. Okay, first comment is about the omitted variable bias in the demand, reserve demand equation. There are at least 3 types of potential omitted variables. First one is about regulation. This paper discusses potential impacts on reserve demand from banks' regulatory needs and balance sheet costs, which are also related to financial regulations. And as you know, during a sample period in the US, there have been a lot of policy regulatory changes. For example, Dodd-Frank Act, Volcker Rule, and so forth. However, the estimation in this paper ignores these regulatory changes. The second one is this, option values from the floor and ceiling facilities. As I said, in this paper framework, demand curve is not affected by floor and ceiling facilities, floor and ceiling rates. However, I wonder if reserve demand may be affected by expectations for potential use of these facilities. Finally, a recent paper finds that reserves associated with commitment lines and uninsured deposit. I think this results makes sense. Firms may withdraw from commitment lines at the same time during stress. So banks may want to hold reserves to prepare for such cases. Also, it may be important to distinguish insured and uninsured deposits. If your deposits are covered by insurance, depository insurance, you don't have to run. So banks, banks may want to hold reserves in response to uninsured deposit rather than insured deposit. So this paper may be improved if we adding some discussions around these potential omitted variables. My second comment is about a possible approach to limit interest rate volatility. according to this paper, the EFFR IOR spread was stable in 2022 to 2024 because overnight RRP or the floor facility worked very well. So my question is, why not maintain this regime? As discussed in this paper, this requires large Fed security holdings. I agree that holding long-term bonds may matter because it may affect the term premium a lot. However, what about T-bills? Maybe according to today's discussion, holding too much T-bills maybe not good because because of the shortage of convenience assets in the market. But what if there are a lot of T-bills due to high government debt? So I think pros and cons depends on the situation of government debt. So you may discuss this kind of possibility a little bit more. Okay, let's move on to the situations in Japan. In this chart, the black line represents the overnight call rate, which is a policy rate of the Bank of Japan. And the red lines represents IORs. As you can see, there are 3 lines from January 2016 to March 2024. During this period, Bank of Japan conducted a negative interest rate policies and set 3 different IORs for different types of reserves. Except for this period and early part of the sample, the call rates has been essentially lower than IOR. In particular, recently, call rates has been very stable. So this suggests that reserves in Japan have been abundant. This view can be confirmed by this chart. This chart compares the reserves and liquid deposits. And the left panel and the right panel show the data of the US and Japan, respectively. And in the left panel, blue line represents reserves plus overnight RRP take-up, which is a proper measure of reserves in the United States according to this paper. And as you can see, a red line, liquid deposit is much larger than this measure of reserves in the United States. On the other hand, in Japan, reserves and liquid deposit are more comparable. I also found the data of commitment line in Japan, and at least in the last 10 years, reserves are much larger than commitments. So this suggests that in Japan, reserves are abundant. Reserves have been abundant. So this chart considers Japan's situation using a framework of this paper. So basically, in Japan, reserve supply curve is really different because in Japan there are no flow facilities. But basically, because reserves are abundant, equilibrium is located at the flat part of demand curve. So even if reserves fluctuate, call rate is hard to fluctuate in this situation. And this is Bank of Japan's situation. So this may help your discussion later. Okay, let me stop here. Thank you very much.
Thank you, Hibiki. I hope that you hear me. Before opening the floor for questions, would you, Annette, like to reply to the questions or comments in the discussion?
Yeah, thank you very much. Really good discussion, very constructive. Thanks a lot for your help with the paper. Let me just comment on a couple of things. In terms of the omitted variables, we of course also were concerned that regulation was changing over time. We have tried various states related to the SLR and so forth. So far we haven't found anything that comes in significant, but we'll keep looking. I think one omitted variable that's potentially interesting is that it's possible that households and firms on the one hand and banks on the other hand have correlated liquidity demand shock. So like when COVID hits, households want liquidity, banks want more liquidity per dollar of deposits. So we thought long and hard about, for example, whether we should instrument for deposits to try to come up with some sort of exogenous movements in deposits. And then we decided that if we can make an otherwise unobservable demand shock observable through its correlation with deposits, we actually don't want to instrument. So, but point well taken that one should think about the omitted variables. In terms of the issue of credit lines, Tara and Rashan in the Jackson Hole, they throw that in there. The R squared, remember, is already 97%, so you can maybe get to 98%. We tried to keep it simple, but you can put it in there to get a little extra explanatory power. In terms of the option value from the floor and ceiling, we think about a framework as basically one period thinking. So like at a given point in time, the bank says, okay, this is my value of having more liquidity. I can either get it in the private market or I can get it from the Fed, and I'm going to do whatever is cheaper. The problem is not dynamic in the sense that we redo this every period. And that's, I think, why we don't get the option value to come in within our framework. Let me stop there to allow time for questions.
Okay, thank you. And now I'd like to have the questions from the audience. And to warm up, I'll pose myself first question before I see any name tags, nameplates raised. So what has changed the most in the last 15, 20 years? Before the global financial crisis, we had a perfect control of the short-term rates without having a structural liquidity surplus. We were in the steep part of the demand curve, and we didn't see any volatility. So is it our capability of estimating the demand or supply or the functioning of the interbank market that has changed?
I think it's what I called active securities. Remember that vertical part of the supply curve, the net securities? At central banks, people remember, still at a lot of central banks, people have, the Treasury has to provide the central bank with forecasts for the government deposits so that the central bank can adjust securities accordingly to keep that vertical part of reserve supply unchanged. And remember at the Fed, we used to have lots of people sitting around trying to do open market operations so that the effective Fed funds rate would clear at just the right value. So what has the main change, you ask, is basically that we stopped doing active securities. If we were to get back to that, then we could have a smaller balance sheet. And I'm not saying, for example, in response to this volatility in the government deposits in the TGA, that we need to sit around and do this every day. If the TGA moves by, let's say, 800 billion, it probably would be enough that every time we see it moving by 50 billion, we would do something. And so that would be kind of a compromise between where we are now of super passive securities and the old system of very active securities.
Sure. Time for questions. So if I don't see any, I'll do them myself. So please do. Okay. First one was Geraldine and then Gurunchas. Yeah.
Hi. Yeah, thank you very much for the presentation. It should be honestly a bit unfair to keep asking about omitted variable in a regression that shares a 0.96 R squared. But while reading the paper, I couldn't help myself but thinking that perhaps there can be a role in your demand equation for some indicator of the exposure of bank to non-banking financial institutions, hedge funds, private credit. I mean, to capture a potential insurance role played by central bank reserves vis-a-vis exposure to this RES-regulated, highly leveraged sector of in the financial economy. So you have liquid deposit, but perhaps disentangle a specific role for those deposits that are exposed.
Yeah, that may be more relevant for dealers
Yeah.
than commercial banks, but I'll think a little bit more through the treasury basis trade and all those exciting things that can move around and see if we can come up with something.
Yes, just to the extent that those are financed by banks.
Okay, next, Mr. Gurunchas.
Yes, thanks. I think this is a really great paper, and it really helps me understand a lot of what's happening there when we want to think about the different regimes with ample reserves or scarce liquidity or ample liquidity. At the same time, people old enough like me remember learning about bill pools in graduate school, and Pools was saying, look, if your shocks are to the money demand, you want to have sort of an interest rate rule, because then you will be supplying whatever liquidity is coming from shifts in money demand, and you will have a stable interest rate. If the shocks are from the money supply, then somehow you want to have a fixed money supply rule, because that will force the central bank to offset whatever is happening to whatever other exogenous variation to the money supply are out there. And I think that same logic is implicit in the framework you're presenting, and actually your answer to one of the comments from the discussion was exactly around that. The active securities is kind of the shocks to the money supply that you try to offset with your repo operation. And so you want to locate yourself on the flat part of the supply curve or demand curve or both, because you're trying to absorb the shocks in there. I'm curious if there's, the technicalities are of course different, but is that the right way to think about sort of the general framework? And another maybe question I had is, you're netting out the deposits from the right-hand side of your regressions. There is the work of Acharya and Rajan that argues that there is sort of an endogeneity of the deposits to what's been happening on the supply of reserves, and that on the way up, we created this huge supply of deposits in the banking system, but somehow it seems hard to undo that when we're doing QT. I wonder if you've thought about this and whether that matters for what you're doing. Thanks.
Yeah, thank you. So, yeah, I also remember undergrad macro, it was if the money demand is unstable, you target the interest rate. I suspect the Bank of England people would say that is precisely why that's why we want to operate at the ceiling, because then if the reserve demand fluctuates around, we are still targeting the interest rate. So that maps directly back to undergrad macro 101. In terms of the deposits potentially being endogenous, as Acharya Rajan mentioned, to some extent, that is already in there. We have in there reserves and deposits as explanatory variables. So to the extent that these are correlated, it's a multiple regression. I think that's kind of fine. Now, I think personally that in their framework, they're emphasizing that reserve supply causes deposits. I think if you take their estimations and then you think not just about the bank's willingness to supply deposits, but about households' demand for deposits, then you would need to throw in basically household wealth, right? So from portfolio theory 101, it would say, if households have more wealth, they're going to hold more deposits, they're going to hold more stocks, they're going to hold more bonds. And we've actually done that exercise. If you put that in there, there's less of a role for this Acharya Rajan channel. But again, we decided to not instrument for deposits because we want them to pick up these otherwise unobservable correlated liquidity demand shocks, but we could talk about this more.
Okay, thanks. Then Mr. Hauser.
Thank you. This is a self-interested question, so I apologise, but kind of as one of the authors of the Bank of England approach that you discussed out there, you had a long list of benefits: less rate vol, destigmatisation of the lending tool, less interest rate risk on the central bank, less independence risk, you don't have to estimate the demand function. Central bankers, in this field spend a lot of time debating the relative pros and cons of these very complicated systems. Do you have any real sense as to whether these differences are first order or second order? And I guess I'm partly hoping to maybe trigger colleagues in the room to sort of come back on the question, because if you just listen to your list, it sounds like, well, there's a sort of clear domination of regimes here, one over the other, and I'm sure that's not true. So I don't know, do we need to care a lot about whether these differences are important for economic welfare, or are they all kind of pretty similar ways of delivering the same outcome?
As I understand it, the rate volatility in the Bank of England case actually has been lower with the positive take-up. So that's an example that I think it does matter. How much benefit you get in terms of central bank profit risk, of course, depends on how heavily you want to use the repo lending versus securities. So that's a choice. depending on how important you think profit risk is. So, I mean, operating framework, you're never going to have the same welfare effects of kind of fudging around with your operating framework as you're going to have from, changing the Fed funds target by 300 basis points. So, it's a question of, how big do you think is big enough that we earned our salary? That's become an issue in Fed context.
Thanks. And then Ms. Koeda.
Thank you for your great presentation. I think the Fed approach requires policymakers to estimate reserve demand as well as to forecast reserve demand. So how do we deal with uncertainty arising from estimating and forecasting reserve demand in actual policy making?
So when I showed you which level of reserve supply would lead to a predicted spread of 4 basis points, I had a 90% prediction interval in there that accounted for uncertainty in estimating those regression parameters as well as the volatility of the error term. So that is definitely possible. But if you wanted to sort of predict what month is that going forward, there's an additional level of uncertainty because you have to predict the path for deposits. And that, of course, would further widen the uncertainty range. But it is, it's possible.
Thanks. Now it seems we are running out of time, so let's make the final round of a couple of questions, and then you choose what to answer. So first, Mr. Himino.
Thank you. My question is about the estimated reserve demand curve, and I was very much impressed by seeing a very stable relationship between the quantity and the spread. And I suppose banks' reserve demand depends significantly on the kind of market psychology. For example, in a dash for cash situation, people wouldn't believe in anything other than cash or Fed reserve. And I suppose this curve includes, for example, March 2020, because it was not the repo rate was not binding. So do you see kind of deviation from the estimated curve in the period of kind of tantrum or kind of stress or panic, or even in that kind of period, the relationship was stable?
Okay, and then Mr. Shiratsuka.
Thank you very much. Shigenori Shiratsuka from Keio University. My question is about the significant change in the market participants in the Fed fund market, and how do you think about the implication of those things? So under the current situations, Fed fund rate is lower than IOER, and so the IOER eligible financial institutions have no incentive to trade in Fed funds market. So lender in the Fed market is now the IOER non-eligible financial institution, something like GSEs, etc. And so almost no transaction between IOER eligible financial institutions in the Fed fund market. So how do you understand those situations and how the implication of those things, and especially about how do you understand Fed fund market rate under those current market situations? Thank you.
Thanks. And then Tsutomu Watanabe.
Thank you very much for a very nice presentation. I have a question about reserve function you showed to me. So your specification is based on semi-log specification. But in the literature on monetary money demand function, there is a long debate between log-log versus semi-log. And recent papers based on recent data suggest that log-log specification performs better than semi-log specification. But you did your analysis based on semi-log specification. I'm curious to know how your result would change if you switch from semi-log to log-log specification. That's my first question. The second question is about your optimal balance sheet size argument. I like it very much because it's very simple and straightforward. However, in your formula, there is no argument like fiscal discipline. However, people in this country often talk about if the BOJ balance sheet is very large, that means that fiscal discipline could be very weak. That's why central bank balance sheet must be reduced to some extent. That sort of argument implies that fiscal discipline is a very, very important determinant of the balance sheet. I'm not perfectly agree with this sort of argument because our government didn't have any fiscal discipline even before BOJ expanded balance sheet. However, still I'd like to hear your view about how fiscal discipline is entering your picture about optimal size of balance sheet. Thank you very much.
And the final question to John Williams.
Thanks. It's not going to be a question. I mean, pretend to be a question. So it's really responding to Andrew, who was trying to get me to respond. So I think you look at the various jurisdictions around the world. They've reviewed their monetary policy implementation frameworks, and in many cases changed those. And the Bank of England is a great example of that. What you see in the communication, I think a lot of the thought, is a number of factors beyond interest rate control. And it's really striking. There's a lot of comments about financial stability, a lot of comments about having an active interbank lending market, concerns in what we call in the United States footprint of the central bank. And I think when you think about the trade-offs here, and I think Annette's paper shows this, you can control interest rates a lot of different ways, and you can do it very effectively. The question I think a lot of jurisdictions are facing is the other objective functions out there, or maybe some institutional or legal restrictions, which come up as well. So I think what's striking here, getting to Andrew's question, is that probably the social welfare differences between a tiny bit of variation in overnight rates is really relatively small. But I think these other considerations seem to weigh pretty heavily in terms of the frameworks that people choose to do. I mean, I don't think there's any question that if you put your administered rates very close to your target rate, it's going to get very tight interest rate control, which is exactly what you're saying. The question, that's not really the question anyone's talking about. The question is, what are the other intended or unintended consequences around that in terms of financial stability and market functioning? And what's striking to me is different jurisdictions have different solutions to that. We're all on a frontier. I don't think it's the frontier about getting perfect interest rate control. It's the interest rate control versus other objectives. That's my observation. We just had a conference in New York on Friday where we discussed this quite extensively, and at least that's my summary. I think we're all trying to be on a frontier. It's just a frontier of multiple objectives. Thanks.
Thanks. And now, Annette, your challenge is to reply in 2 minutes to these 4 questions.
Okay, let me give it a go. So March 2020 is in the data set. I think, of course, as you said, reserve demand went way up, but reserve supply also went way up. Remember how the Fed did, extensive market functioning purchases right at the peak of the crisis. So I think that's why we managed to get the Fed funds target to not go really, or the effective Fed funds rate to not go really high. In terms of the participants in the Fed funds market, I agree with the interpretation about the main lenders being the GSEs, and they're willing to lend, in practice, 7 basis points below IOR currently, because they don't have direct access to the interest rate and reserve. So I agree with that comment. On semi-log versus log-log, yeah, I mean, as Bob Lucas, has laid out, there's different approaches. Because we have a spread, it's Fed funds IOR, you can't take the log of a negative number, so we mechanically cannot do log-log. So that's why we do semi-log. The reason that people can normally do log-log is because you just have cash, which doesn't pay interest. So it's just R, it's not R minus IOR. So that's just not possible. On the issue of fiscal discipline, I think there's lots of interesting issues there. For example, you could take a related issue is Remember that extension of the Friedman rule I put up at the end where I said if the Fed holds treasuries, we should equalize the convenience yield on reserves and treasuries. But you could say which treasuries? How does that interact with debt management? What about bill versus bond supply? You could say, shouldn't we collectively, we the consolidated government, equalize the convenience yield on reserves, bills, and bonds? That's not what goes on in practice. In practice, the convenience yield on bonds now is somewhere around 30, 40 basis points, where that on bills is much lower. And I think that gets back to the fiscal authority essentially having a different objective function than maximizing effective money supply. You know, if you ask the Treasury, they would say, well, we need to think about the cost to taxpayers. So essentially what they're doing is they're trying to figure out what's a good deal, not in terms of just the convenience yield, but the convenience yield times the quantity that they fund at that convenience yield. And so I think that's why we often get these sort of different thinkings about how things should be managed across the fiscal authority and the central banks, is because we think liquidity and they think liquidity premium times quantities, and that doesn't always give the same answers.
Thank you, and I think it's now time for a big hand to Annette and Hibiki.